Yesterday, Barclays Bank, as I said, kicking off the bank's earnings season, and what investors are paying attention to when it comes to these earnings reports is the impact of inflation, interest rates, forex fluctuations on profitability. What's your sense of the tone that's been set so far?
Good morning, Alishia. Well, the results were really impressive considering how the bank has progressed over the tough times we had last year, especially when the shilling had really depreciated. What I would say is they've managed to maintain profitability by focusing more on non-funded income. If we look at the customer deposits, they really did drop, but that was mainly, of course, because of the high rates towards the latter part of last year. So I think right now the focus shifts more to policy. If we have the credit reserve ratio reviewed positively in favor of the banks, I guess we would see more credit creation, and that in itself would bring more business for the commercial banks.
On the flip side, we've had Barclays warn that Kenya could suffer a credit squeeze if Parliament's move to control banks' lending rates are to succeed. That certainly brought about some caution in the markets. What are you making of that possibility of a policy like that coming through?
Well, that will definitely be a sharp blow to the banking sector. But I think if you look at past trends, you see there have been a number of such bills before and they did not make it through. But if this does make it through, indeed it will be a talking point for the banks. But all the same, I don't think it will sail through.
Okay, well, let's move on to today, because East African Breweries out with numbers this morning and saying that first half gross profit rose to 13.46 billion shillings. First half pre-tax profit as well up to 6.67 billion shillings. What have you made of those headline numbers? I'm not sure if you've had time to fully dissect that earnings report that's filtered through this morning.
Well, those are very good half-year earnings reports, considering the tough time they've had, especially when they had advertising banned about 2 years ago. They've also had stiff competition regionally. So looking at that performance, it's really a commendable performance. They mainly focused more on marketing their smaller brands, which are faster moving, like their Tusker brand, which increased in sales, and the Senator brand, which increased in sales. So I guess for them, it has been more of a successful marketing model. And moving on also, I guess the regional expansion has helped them, and this should be able to keep them in profitability for a while.
We've got that share price up to 176 shillings. It traded 0.6% to the good by the close of yesterday's session. Robert, are you a buyer at these levels? What are you making of current valuations?
I believe 176 is a bit expensive right now, but considering the trends and looking also maybe at the dividend paid out, it may have an effect on the demand and supply in coming weeks before the books closure. But right now, to buy at 176 may be a bit high, especially considering these are half-year earnings, and also considering the time of year we find ourselves in the first quarter. It may be a bit expensive to get in at 176.
Is it worth it, though, if you're vying into this market for exposure to more defensive stocks out there? Some saying that defensive characteristics is what you're after. You're after those high dividend payers with relative insulation from forex and rate movements, and those that have pricing power as well.
Yes, that is one way of looking at it. Though the dividend yield on East African Breweries is not as high, to solely focus on dividend as an entry point. But also looking at maybe if you look at risk, there are other stocks which one would look for in terms of higher risk premium than East African Breweries.
Give us a sense of what you're looking at and what you're casting your glance towards, Robert.
Pardon, I didn't get that question.
Just give us a hint as to where you're finding some of that opportunity then.
Right now, the risk premium has shifted more out of the equities. It's gone more into the money market. Right now, people are looking at risk-free assets. People are moving to real estate. People are looking at fixed income securities where there are higher and more grounded returns right now. So I would look at the infrastructure bond the government is about to offer as a possible investment opportunity especially in the short term.
What does that say then about your exposure to the equity space specifically? Because we've got the NSE All Share Index trading at a PE ratio of 7.3%, and many out there saying it's a good entry point into the stock market, especially where you've got some, albeit cautious, optimism about.
Yes, definitely. The market is cheap right now, if you could use that word. It's a good entry point for the long term. Right now, people are taking positions. I was talking more of short-term returns. If you're looking at short-term returns on investment, right now would be the wrong time to get in. But if you're looking to sit back, hold on to the stocks for the long term, right now would be the perfect time to get in, because most of these counters are trading at discounted values, especially the banking sector.
Let's hone in on that banking sector, because of course, as we highlighted earlier, we've had Barclays Bank setting the tone for the rest of the banks, and we saw some of that spillover effect take place yesterday, where we had the likes of KCB and Barclays Cooperative Bank all riding on positive momentum.
Yes, right now I think Barclays should be having a trading P of about 8.3. This puts it at a very cheap position if you want to get into the stock right now at 12 shillings and 40 cents to about 13 shillings. So looking at its counterparts like KCB, Equity Bank and Cooperative Bank, we expect the full year results for 2011 to be equally impressive. And right now, looking at the sector, average should be below 10. I probably put it around 8.5. So looking at the sector, I guess it's one of the best times to get in, both for the medium and the long term.
Yep. What about Safaricom? Because that was the most actively traded counter in yesterday's session, and some commentary coming through that at about that 3 shilling 34 mark, it's signaling further upside traction, Robert.
Yes, and mainly because that demand was from foreign investors. Foreigners have moved into Safaricom, and they're taking positions on the stock. They're moving large volumes, as we saw yesterday, and this, I guess, is because we expect their full year earnings report by the end of March. And right now it's more of position taking. This should push demand also locally for the stock, and we would see the price probably rally anything between 10 to 15% before those results are out in March.
Moving out into Safaricom possibly, but out of Access Kenya in a big way. We had that share price down 2.3% by the close of yesterday's session, Robert, and hitting a fresh all-time closing low.
Yes, Access Kenya has been low on demand, mainly because of investor perception rather than fundamentals. And looking at the stock, I guess right now it's at a rock bottom. I don't think it will go anything below 20% of what it traded yesterday. That is at least in the first quarter. So I guess as an investor, I would be getting in right now, but as a speculator, not maybe someone who is getting in for the long term.